Welcome to Excess Returns, where we focus on what works over the long term in the markets. Join us as we talk about the strategies and tactics that can help you become a better long-term investor.
Justin Carbonell and Jack Forehand are principals at Validia Capital Management. The opinions expressed in this podcast do not necessarily reflect the opinions of Validia Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validia Capital.
The ETF industry is dominated by the big players. They control most of the assets and they have some clear advantages over the smaller companies within the industry in terms of their ability to launch and grow products. We know this firsthand since we launched our own ETF in 2014, not exactly the best timing for a systematic value strategy, by the way, and that eventually didn't work out for us. But just because big firms control most of the assets, that doesn't mean they offer the most innovative products. Some of the most interesting products we have seen come from smaller shops who are not afraid to challenge the big players. We have been fortunate to interview many of them in the 3 years since we launched our podcast, and so we thought it would be interesting to put together into a compilation some of the smaller firms that are helping to launch new products that give all of us more of a robust series of choices within the ETF space. Here are some of the more interesting ETF companies we have featured on Excess Returns. But before we start, one important caveat: like everything we do on Excess Returns, nothing we discuss here should be considered investment advice. Our goal is not to recommend any specific ETFs, but rather to highlight some of the more innovative work and investment strategies being done by the guests we've had a chance to talk to. With that out of the way, here are some of the more interesting ETF concepts we have seen on the podcast. To set the stage for our discussion, we thought it would be useful to understand the ETF space in general and what the landscape looks like for smaller firms trying to break in. So we reached out to our good friend Wes Gray. Wes knows more about the ETF space than probably anyone we know. Not only has he built a very successful company himself in Alpha Architect, but he also founded ETF Architect, which is a firm that helps other firms launch their own ETFs and has launched many of the ETFs we will discuss in this episode. We asked Wes why the ETF space has been dominated by the big players.
Hey, Wes, thanks for jumping on with us today.
Hey, Justin, thanks for having me here again.
Yeah, so we're doing this special episode on ETFs and the ETF sort of landscape. And, we thought it would be great to have you on. I mean, you've created Alpha Architect, which is a successful but smaller ETF company. You've been doing that for a number of years and just grinding it out and developing great investment strategies. And then through your new firm, ETF Architect, you're sort of becoming one of the more, premium white label ETF providers out there, launching new ETFs and helping get other strategies to market through the ETF wrapper. So, we thought it'd be great just to sort of set the stage here with some of your observations about what you're seeing, but also where things might go sort of in the future. And to start, we wanted to ask you, I think, and most investors that are in the ETF market know this, that most of the assets are dominated by, a small number of larger players. Maybe it's starting to change here. But it's still a lot of the assets are sort of concentrated. So to start, we want just to ask you, why do you think that is? And what advantages do the big players have over smaller companies?
Yeah, so I think the reason that exists is simple. There's massive barriers to entry, as you guys know, to get into asset management. And it basically boils down to two areas where the costs are. One is operational, and then two is distribution. On the operational front, that's basically what the vision for ETF Architect is, hey, how do we lower barrier to entry on accessing the marketplace from like an operational, legal, compliance perspective? But then the other challenge is obviously distribution. And, if you have a lot of resources, you could hire a lot of wholesalers, you could pay a lot of kickbacks to the banks, you could, buy a lot of steak dinners for, financial advisors, all that sort of fun stuff. And that just comes with economies of scale. And so, just by nature of the business, it's a high fixed cost industry. So I think that's why historically, and even today, it's just more challenging for smaller firms.
Mm-hmm. Mm-hmm. I think one of the things that I see is people like Meb and you and others are pretty forward-leaning, much more forward-leaning with content and trying to get out there and educate. A lot of these larger firms are doing that to a large extent too. They have good educational parts of their site, but they're not maybe as forward-leaning or they have been at with the podcasting, with content and stuff like that. So, would you say that's maybe one advantage that sort of some of these smaller players have?
Of course. So, being from the military, I got an acronym for everything. And so what we always say is boutiques have to be fast. And what does fast stand for? Well, they got to be flat, right? They can't hit huge bureaucracies where it takes them 10 months to talk about a tweet. They have to be authentic. BlackRock handle, if you've ever read it on Twitter, it's not exactly the most authentic or inspiring piece of work, right? Larry Fink rides his Learjet and then talks about climate change. So you got to be authentic. You got to hold yourself out there of actually living and breathing what your message is. And then finally, S stands for social savvy. Same thing, right? They know how to actually leverage social media to give them scale in marketing distribution on the cheap. And then finally, the last thing, the T in fast, is a thought leader. And a thought leader is just not saying I'm a thought leader. It's actually doing stuff that's innovative, different, unique, and to bring a different idea to the marketplace. And on our platform alone, we kind of specialize in operators like this, but just some quick examples. You got like Perth Toll. She invented freedom weighted, investing. You got a guy, Ray Micheletti. He literally is the PhD who invented relative sentiment indicators. And then another example might be like Kai Wu, right? Like he's on the forefront of bringing machine learning into trying to understand how to quantify intangible value. So these folks are just fast. They're flat, they're authentic, they're social savvy, and they're thought leaders. And I think that works. And I don't think Vanguard and iShares and others are going to be able to, that's not their edge, clearly.
Yeah, well, that FAST acronym. Let me ask you, one of the things that you guys have done, I think a really good job of, is lowering the fees of your funds over time. Like as you've grown and gathered more assets, that fees are important to the investor and the returns that they get. And, investors are attracted to, the less they pay, the better it is for them. So I'm just curious on, do you think that the fee compression is always going to be there? But do you see that sort of starting to wane? Is it starting to level off? I mean, have fees gotten to kind of where they are and aren't really going that much lower for not the passive stuff? I'm talking more active boutique-ish type stuff. What do you think?
So, let me talk specifically to Alpha Architect, right? Because we're kind of unique in this calculus. So our deliverable, our value proposition, what we call affordable alpha, right? So we are specifically trying to figure out how to kind of vanguardize weird, boutique, non-scalable investment strategies. So for us, we're going to always be about lowering cost if we can support it financially and robustly. That's our mantra. But we're also a little bit weird in the sense that I do believe that in general, the fee wars are probably over for the most part within asset management. So I think the prices, just knowing the cost of production, which we also know a lot about, and we are lowering a little bit, by the way. It's just, if you're a small boutique and it's unrealistic that you're ever going to expect to raise more than say $200, $300, $400 million, you have to charge a fee to be able to deliver your service, or you're not going to do that profitably. So I think the fee wars have kind of reached their macro equilibrium. They can always come down over time as cost production comes down, distribution costs come down, but I think they're pretty settled. I think the real war in fee is going to be on the advisor side, because Vanguard, as a lot of people are aware, has specifically, moved their targets from, instead of being on asset managers, they're now moved towards advisors. So I think that's where the real battles are going to be had in the future. And I think we're pretty close to status quo at this point.
When you, last question here, when you look out over the next 10 years, do you think the industry will be more or less dominated by larger firms? And I guess what other things do you see sort of coming on the horizon, changing in the ETF landscape?
I don't think that'll change just because of the cost production of the good that we provide, which is investment advisory services. And so for any sort of product that has massive scale, like an index fund where I could put $1 trillion in it and not move anything or do anything, that's obviously going to go to like the low cost provider, like a Vanguard of the world. But then there are obviously a lot of things that actually require research, R&D, and investment in time and effort, i.e. the realm of boutiques. So everything that Vanguard can't do efficiently, like they're not going to be able to run concentrated factor funds with deep research that they've tried and haven't been successful. They're just too bureaucratic. They're the anti-fast, right? So I think that you're always going to have boutiques that are going to be able to succeed in their lane where they specialize and have unique expertise. And of course, in the big commodity products with massive scale, the winner in those markets should be the low cost producer, like the Walmart of that business, which, that's Vanguard, that's iShares, that's kind of State Street. So I don't see that changing that much, to be frank.
Yeah, that makes sense. Well, it's going to be fun and exciting to see the new ETFs and strategies that get launched on ETF Architect. And thank you for joining us and helping our audience get the lay of the land in the ETF landscape and business.
You got it. Here's the ETFs.
The Freedom 100 Emerging Markets ETF, FRDM. One of the coolest stories of success in the ETF space we have seen is from Perth Toll and the Freedom 100 Emerging Markets ETF. When we first met Perth at an investing conference, she had only the concept and was looking for a way to turn it into an ETF. She did that in 2018 with $2.5 million in assets, and now her ETF has over $250 million in it, and it's been a huge success. This is a testament to Perth's determination and also her concept of excluding the countries with the least amount of freedom from the emerging market universe. We asked Perth about this idea when we had her on the podcast.
Yeah, so traditional emerging markets indexes out there are typically very heavily weighted in some of these autocracies. Or countries that don't have a lot of protections for personal and economic freedoms. So, and that's because of the country classifications and market capitalization weighting, which is the standard weighting method. So with that type of weighting, you get a higher allocation to China. So you have about 38% to China right now. MSCI, I believe, is either completed or almost in completion of their additional A shares inclusions, so which quadruple their A shares from 5% to 20% as a target in the index, and that brought their China allocation up to like 43% by August 2020. Now that percent has come down since then because of relative performance, but currently it's about 38% in that index. So that's one country alone. China has 38% of most emerging markets indexes. In addition, you have allocations to Russia, to Saudi Arabia, which was added in 2018. So, and those are not small allocations. Those are all top 10. So you have, more than 40%, approaching 50% in some of these highly unfree markets with very questionable human rights practices. And then just, not a lot of freedom to innovate. So that's kind of the problem we're looking to solve. And we do that by freedom weighting. So freedom weighting is where you give the freer countries a higher weight, less free countries lower weights. And the worst offenders are naturally excluded as a result of the freedom weighting. And so we have actually no allocation to China, Russia, Saudi Arabia, Egypt, Turkey, or any of these very unfree markets. And that's just a natural result of the freedom weighting.
The IMGP DBI Managed Future Strategy ETF, DBMF. 2022 has been a great year for managed future strategies. With stocks and bonds declining together, investors have begun to understand the value of diversifying strategies like managed futures that have different return profiles than the standard stock and bond allocation. One of the biggest beneficiaries of this has been the IMGP DBI Managed Futures Strategy ETF. We had Andrew Beer, who is the founder of Dynamic Beta, which manages the fund, on the podcast, and he explained what managed futures are and how they can benefit investors.
Managed futures is a strategy that's been around forever. And, we've been around for 50 years or something. And I think we are still trying to come up with a single sentence that resonates with everybody. So what it basically is, it's a computer-driven strategy where people are looking for trends. And they're looking at recent history. So it's almost like technical analysis, where you're looking at the, interest rates and how they've been moving. Are they likely to keep moving up? And so some people call it momentum, some people call it trend. But the basic idea is that, we humans drive a lot of things that go on in the markets. We're very emotional. We don't respond to things quickly. We can overreact, et cetera. And these cold, rational machines can weather a year like this. Now, the return profile of managed futures is, I think it is absolutely, utterly obvious as an asset allocation in a broader portfolio. And the reason being that, it has zero correlation to stocks and bonds over time, although they will go up or down. But it's hit the trifecta. It made a lot of money during the dot-com crisis. It made a lot of money during the GFC, and it's up 35% this year before fees. So there is no other strategy that I'm aware of from a diversification perspective where you say, I'm starting with 60-40 and I want to peel off 10 and put it into something. I think this should be everyone's first port of call.
The Acquirers Fund, ticker symbol ZIG. It is possible that after a very long winter, value investors like us might finally be having our day in the sun. We owe much of what we know about value to Tobias Carlisle, who holds the record for the most appearances on excess returns. Toby is the manager of the Acquirers Fund, which takes a unique approach to value. We asked him about the Acquirers multiple, which forms the foundation of the strategy when he joined us earlier this year.
The strategy itself is very, very simple. It looks for these companies that are cheap on an acquirer's multiple basis. So the acquirer's multiple, for people who don't know, is the metric itself is basically operating income. But you might think of that would either be EBIT or EBITDA are well-known examples of that. So that's earnings before interest and tax, depreciation and amortization, which is basically the accounting version of cash flow that goes into that management gets, that they then decide how they direct that. And they can direct that in various different ways. They can use it to pay down debt. They can use it in CapEx. They can use it to buy other companies. They can use it to buy back stock. And then the way that you determine whether it is cheap or expensive is you compare it to the enterprise value. So the enterprise value is the market capitalization. So if you think about your house, you own your house and you pay $100,000 for your house, but you have a $80,000 mortgage on your house. So the market capitalization of your house is $20,000, and it doesn't reflect the mortgage that you have. That is an amount that is a real liability that you have to pay off over time. And so the enterprise value captures that debt number, and it captures other things that are debt-like, quasi-debt. So preference shares have a requirement that they have some sort of dividend that is preferred to the common. So it has to be paid out before the common can receive its dividend. There might be minority interest. So somebody else might own a piece of the house, and that needs to be reflected. In some circumstances, you might find that the house has a safe inside it and there's some cash in that safe. And so the actual cost of your house is much, much lower than it appears on the outside, because you find the safe and it's got $100,000 in it. So the real cost of your house is zero, because you could take that cash and pay off the house. And that's essentially what the enterprise value is. We're looking for companies that have got more cash than debt, or they don't have any of these hidden parts. And then we compare the two together so we can get an apples to apples comparison of all of the companies in the market. Now that sounds like it is a very simple metric compared to the full analysis that other investors do, but it's also a very powerful one because it does contain a lot of information in it. And when we test that idea relative to other simple metrics like price to earnings or price to book or free cash flow to enterprise value, we find that it has performed the best over the data set that we have, which is 1963 to date. But there are long periods of underperformance, and there are multiple periods through the long series of data that we have where we've had these well-known manias, well-known bull markets, and there are about 6 or 7 through the whole data set where value does really badly. We're sort of looking for these flows isn't helpful at all. So it's a very long-term strategy, and it's money that you shouldn't need in the next sort of 3 to 5 years that you can put into a strategy like this, so that you can give these companies enough time for the market to sort of forget about the reasons why they're undervalued in the first place, and to start valuing them again on their fundamentals, which Benjamin Graham would have said, in the short term, the market is a voting machine, but in the long term, it's a weighing machine. And so that's what we're trying to buy these things when the market's voting against them, and have them eventually weighed on their merits. And that's value investing.
The Sparkline Intangible Value ETF, ITAN. One of the things many value investors have recognized in recent years is that companies we are valuing are very different than the companies of the past. The rise of intangible assets like intellectual property and brand value have led many to challenge whether traditional value investing metrics like the price to book are still relevant today. Recognizing that fact is one thing, but incorporating it into an investment strategy can be a much more challenging step. Kai Wu at Sparkline Capital is one investor who has tackled this problem head on. He uses machine learning to estimate the value of intangible assets and then incorporates those values into his valuation metrics. Kai explained this in more detail when he came on the podcast.
So I know your audience is very familiar with value investing and quantitative value investing. The idea of buying low, selling high against some measure of fundamental value. So I'm also a value investor. I started off my career working for Jeremy Grant and the GMO. So my kind of time has been spent trying to answer one question, which is, how has the definition of value changed over the past century? Or you go back to the 1930s when value was first pioneered by Ben Graham and the economy was industrial. The biggest companies were railroads and steel mills. And you fast forward to today, and now we have Apple, we have Google, Microsoft, totally different world, totally different drivers of value today. I like this quote by Warren Buffett. It's on my website as well. The 4 largest companies today by market value do not need any net tangible assets. They are not like AT&T, GM, or ExxonMobil, requiring lots of capital to produce earnings. We become an asset-light economy. So what is Buffett saying? He's saying that the moats that companies in 2022 use in order to gain a competitive advantage and to drive earnings are different from those 100 years ago. It's not physical capital; it's instead intangible capital. So at Sporkline, we have 4 pillars of intangibles we use to kind of categorize this amorphous world of various drivers of value. And these 4 pillars are brand, human capital, network effects, and intellectual property. What we found in our research is that intangible assets, if you look as a percentage of, say, the corporate balance sheet in the US, or as the percentage of the stock market cap, has risen from basically 0 in 1980 to basically 50% to 80% today. So a huge rise in the balance sheet angle. You look top down in national accounts, what you see is that, more GDP was invested in intangible as opposed to tangible capital in 1990, and that gap has widened ever since. So intangible investment has become a bigger and bigger share of investment today. So it's pretty clear that the economy has transitioned and is becoming increasingly intangible over time. What's the problem? You alluded to it already in your question, which is the accounting, right? Which is accounting is the foundation upon which all valuation work is being built on. And it's not kept pace with all the innovation and transformation we've seen in society. There's a book I like a lot. I've talked about. It's called The End of Accounting by an NYU professor, Bruce Lev and Fung Gru. And one of the really cool exhibits in their book is where they show a cross-sectional regression of book value and earnings as ability to explain market cap. And you can see the R-squaring was about 90% in 1950, and it declines down to less than 50% today, right? So what that is saying is that, as the economy is transitioning to be more and more intangible, traditional accounting metrics, such as book value and earnings, are declining in their explanatory power. So what is the problem with accounting? I think there are kind of 2 categories of issues that are experienced. The first is inconsistent capitalization rules. And so what I mean by that is that the way that accounting frameworks deal with intangible as opposed to tangible investment are different. If I put a bunch of $100 million, let's say, in building a manufacturing plant or a factory, that gets capitalized. It goes on the balance sheet of the company and then gets depreciated over time. Whereas $100 million spent on, say, a COVID vaccine, R&D development ends up becoming an expense. So we're going to take it out of net income that year, and there's no balance sheet item, which is, of course, ridiculous because you have firms whose only job is to do R&D or to build brand equity, and those things don't appear in their balance sheets, right? Coca-Cola spent $100 billion on advertising over the course of its lifetime, and 0 is on its balance sheet as a brand equity item. And so the second category of problem is just pure omissions, right? So we saw that with brand and IP, it's more an issue about how the accounting investment is being treated, different than physical investment. But on the other 2, so human capital, network effects, there's basically no mention. The only thing we see is that on the human capital front, there is, like I mentioned, of the number of headcount a company has, which of course is not very useful because it doesn't make any distinction as to the quality of these employees or what they even do. And then on the network effect side, I mean, you have all these companies for whom like the primary store of value, if you're like Lyft, right? All your values in your driver network, that's not an on-balance sheet asset. So, how we might think about that, I'm just looking at accounting statements.
The Freedom Day Dividend ETF, ticker symbol MBOX. Another metric many value investors like to look at is dividend yield. Many investors like to search for stocks that have the absolute highest dividend yields, but research shows that for deep value investing, there may be better metrics to use. It can also be argued that the best use of dividends isn't as a value metric at all, but instead as a way to find high-quality companies. With the Freedom Day Dividend ETF, Ryan Kruger takes that approach and looks for high-quality stocks that are growing their dividends. In our interview, we tackled each of these 2 ideas with Ryan. First, we asked him about his view on dividends.
High yielding anything, dividends just being one of them.
is more often than not a red flag to me. I've just been around too many enticing to what do I owe this great act of generosity is my first question. And in dividends in particular, you pull the curtain back just even a little bit and wonder, well, if free cash flow is plummeting, debt is being issued, there's no top line growth, but there's this big fat juicy dividend. And by the way, I'm talking about some of the largest holdings of some of the most popular dividend ETFs and funds. That's more than a problem to me. And so that's number one, the red flags. But I think what sneaks up on people and the beauty of dividend growth is you're not taking a step back and merely getting a lower yield and being safer. But as you might have seen that simple Yogi Berra math that I like to talk about, arguably one of the sneakiest, best Hall of Fame resumes ever. And everybody talks about his great quotes and know the guy, but very few people know what he batted, which was 285. And if you take a 2% dividend, growing at 8%, 8 years later, that's a 5% yield on cost, which is already better than the 4% high yielding dividend that may not be raised at all. So that's simple math. And the dividend growers that I want to wait for are far in excess even of 8% a yield, but that's just some simple conservative math. That to me, that dividend growth model and really the math that I think most important to people that are calculating their mailbox money and all they need is a back of an envelope to do it. No fancy algorithms is what is dividend yield. And when it is growing over time, boy, that number can get up there in a hurry. And all of a sudden, if you've got a 5, 10, 15% yield on cost, good luck trying to rip that security out of somebody's hands during market volatility. That's a whole different question for that stakeholder, in my opinion. So I think it is a behavior issue as well.
Ryan also explained how he looks at the quality part.
You could have a table full of different metrics to choose from, and a lot of them would make a lot of sense and be good answers of very traditional quality. I don't think a lot of them are secrets, though therefore the uncrowded trader in me wonders, where's the opportunity? So I think the way I would answer that question, and to make this more accessible, and I would argue a more challenging question for the smartest quants out there, is I'll sit down at a dinner table with my own kids and ask them what business will still be doing the same business 10 years from now. That's a very short list. It's a fun game, by the way, to talk to kids about capitalism, but I think professional portfolio managers have a very difficult time, and it's very subjective, but consistency would be where I'd start with that quality, because I don't think it's an easy question to answer. And I think that shortens the list considerably on where to start. I know that's not a hardcore answer, but I think because of the way you frame the question, I think that's where some of the biggest opportunities lie. I think there's very few companies that have consistency over time, including their dividend policy.
The Disciplined Fund ETF, ticker symbol DSCF. Another interesting use of ETFs is to utilize them to build an overall asset allocation using or within the ETF wrapper. Because of the tax efficient nature of the ETF structure, the negative tax consequences of rebalancing can often be eliminated, leading to better after-tax returns for investors. Disciplined Funds founder Cullen Roach came up with this very interesting way to do that using a concept he calls counter-cyclical rebalancing. He talked about this in detail in our interview with him.
The way I like to think of it is that basically what happens in a typical index fund is you have, for instance, let's say like a 60-40 stock bond fund. And what happens in that fund is that over time, the stocks naturally outperform the bonds. And so you get 60-40 and it grows into 70-30. And at some point over the time horizon there, if you want to maintain the same risk profile, because typically stocks will expose you to more risk the more they're exposing, or the larger they become a part of your portfolio, you have to rebalance that. And so, rebalancing is a very standard part of portfolio management. But the kicker is that oftentimes when we rebalance that 70-30 back to 60-40, we're not always measuring it the same way. We're not always rebalancing it back to the same level of risk, importantly. So for instance, in a period like 2008, a 60-40 is way different than it is in 2010. And so what I actually do is I take the benchmark and I rebalance it counter-cyclically. So if your benchmark is 60-40, and let's say that your portfolio grows to 65-35, well, our benchmark is essentially more dynamic in both directions. And so I'll actually take the portfolio at times back to 55-45, for instance. And so again, what I'm trying to do there is not necessarily time the market or try to generate better, alpha or better returns necessarily. What I'm really trying to do is I'm trying to buffer the investor from the potential that they'll overreact. So reducing the risk profile at certain times, especially during like big macroeconomic booms, where I'm reducing the amount of equity risk because we're basically quantifying the macroeconomic risks as being slightly elevated. And so rebalancing a little bit more dynamically, it's rebalancing in a very tax efficient way, the way that we achieve it. So the way that the strategy is designed, though, is to be a behavioral target where we're keeping people, in line with their risk profile and hopefully performing better because they behave better ultimately.
One of the things you often hear about in the ETF space is that all the good ideas are taken and there's nothing new anyone can come up with. Simplify ETFs has certainly proven that wrong, though. They have launched over 20 ETFs, and the majority of them are ideas that hadn't been done before. Many of the ideas take advantage of the concept of convexity. Simplify's Harley Bassman explained the concept and how investors can benefit from it when he appeared on our podcast.
We use the word convexity because it has X's and a V. It sounds like fun, and then we have all the Greek letters. Just ignore that nonsense, man. We just say that to the market is great to you. Convexity is very simple. If you have called a bet, although we don't like using gambling terms on Wall Street, then you have a bet that can pay off 1 point if things go up and lose 1 point if they go down, equal, like up and down 10 basis points or up and down 5%, whatever it might be. If you make a point or lose a point or an equal change, that's zero convexity. If you make 2 and lose 1, positive convexity. Lose 3, make 2, negative convexity. That's it. Nothing more, nothing less. It's just, is your return linear or nonlinear?
Yeah, really kind of made the light bulb go off in my head about the benefits of convexity is this idea that if you have a convex product that moves against your core portfolio, and if you're willing to rebalance that convex product when it has its convex return while your portfolio is going down, you can increase the return of your portfolio even if that product has an expected return well below your portfolio. So the idea of like rebalancing during those events can actually increase your return. I mean, you can tell me if I have that right, but that was really when the light bulb went off in my head.
You have stumbled into the truth miraculously. So in product we offer where you buy the insurance policy, right? Market drops down and there's 2% you've invested in the puts, right? The insurance policy, all of a sudden it is worth 5%. What you can do is sell that thing off, take 2 of those 5 points and rebuy new puts, take the 3 points and buy more stock. And that is very clever because if you go down and bounce back up, you instantaneously reinvest at the lows and capture that. Whereas most people will have their equity exposure and then have, they'll go to some hedge fund that offers an insurance product. You know who I'm talking about. And the problem then is they might win, but your money's stuck there for 2 months till you can get it out. And you have to pay taxes on that gain. It's very inefficient to do that. So we basically taken, like I said, we haven't invented the wheel here. We've taken good ideas and improved them. That's all. We put them into an ETF format that you can trade on the exchange. Point and click, really easy. And the strategies are relatively simple. It's just putting in professional products into something that's just so unique that it seems new, but really it's not anything earth-shattering.
It's hard to know where the ETF industry is going in the future, but the one thing we can say with a high level of certainty is that the rise of ETFs has been a significant positive for investors. It has resulted in lower fees, it has improved tax efficiency, and it's resulted in the launch of many innovative strategies that wouldn't be possible in other vehicles. Whatever the future holds, it is likely that the smaller firms will play an increasingly important role in it, and that is likely good for all of us. Thank you for listening.